Are you thinking about selling all or part of your business, but don't know how much capital gains tax you'll need to pay? Well, stay tuned to find out. Hi there, I'm Liam Dargan here from First Formations, the UK's leading company formation agent. Capital gains tax, or CGT, is a tax on the profit made on the disposal of certain valuable assets such as property, shares, works of art and business assets. If you operate a small business as a sole trader or partnership or own shares in a limited company, you may be subject to CGT under certain circumstances. In this video, we explain how capital gains tax works when you dispose of all or part of a business asset, including company shares. We discuss when CGT applies, how much you will pay, and the different allowances and reliefs that you can claim. So let's get started with what is capital gains tax and when does it apply? CGT is a type of tax that individuals and certain business owners must pay when they sell or dispose of particular assets that have increased in value. You pay tax on the gain you make, rather than the money you receive. Generally, the gain is the difference between the price that you originally paid for the asset and the price that you sold it for. For example, if you buy a commercial property for £250,000 and later sell it for £350,000, you will pay capital gains tax on the £100,000 gain and not the full sale price. CGT may also apply if you give away an asset or sell it for less than it's worth. In these situations, the tax charge is usually based on the market value of the asset at the time of its disposal. Now let's consider who pays capital gains tax. Well, capital gains tax is payable by private individuals, self-employed sole traders and partners in business partnerships, company owners, trustees, and personal representatives of deceased persons. Limited companies are not subject to CGT. Instead, they pay corporation tax on any profit generated from the sale of their business assets. However, if you sell all or part of your company, you may have to pay capital gains tax as an individual on the personal profit you make from the sale, as well as any business assets that you retain. Business assets are tangible and intangible possessions that create value for a business. The types of business assets that may be subject to CGT upon their disposal include land and buildings, fixtures and fittings, plant machinery and vehicles, company shares or bonds that are not in an ISA or personal equity plan, registered trademarks, customer lists and goodwill, and that is the business brand, reputation and customer base. These are referred to as chargeable assets. For capital gains tax purposes, a disposal of any such chargeable asset takes place if you sell it for more than the price you paid for it, sell it for less than it's worth, give it away as a gift or transfer it to someone else, trade it in for something else, or if you receive compensation for it, for example, from an insurance payout. CGT does not usually apply to business assets that you give away to charity or those that you give or sell to your spouse or civil partner. This is because no gain or loss is deemed to have taken place in these circumstances. However, there are exceptions, which we'll discuss a little later. Now let's discuss capital gains tax when selling your business. Whether you're a sole trader, a partner in a business partnership, or the owner of a limited company, you may have to pay capital gains tax when selling all or part of your business. If you sell a sole trader business or a partnership, you will pay CGT on any capital gain that you make from selling the business. This gain may be the money that you receive from the sale, as well as any business assets that you keep for yourself. If you sell a limited company or your shareholdings in a limited company, you will pay CGT as an individual shareholder on any personal capital gain that you receive from the sale. And this can include the profit that you make from selling the business as a whole, and that is its trade, assets and all shareholdings combined, the money you get from the sale of your shareholdings, and any assets of the company that you keep for yourself. The amount of capital gains tax that you pay on the disposal of shares or the business is based on the difference between what you paid for the shares or the company or their value when you started the business and what you sold them for. If you sell the entire business as a going concern rather than simply structuring the sale as a disposal of shareholdings, The company may also have to pay corporation tax on the sale of its business assets before the proceeds are distributed to the shareholders. Therefore, when selling a company, it's normally better from a tax perspective to structure the sale as a disposal of shares rather than an asset sale. Otherwise, the proceeds may be liable to both corporation tax and capital gains tax. So far, we've established who pays this tax and when. However, how much capital gains tax will you need to pay as a small business owner? When you dispose of a business asset or sell your business, you need to work out your gain to determine whether it's liable to capital gains tax, and if so, how much. You won't pay CGT on any gains in a tax year that are within your annual exempt amount, which is your tax-free allowance for CGT. The tax-free allowance for the 2023-24 tax year is £6,000 or £3,000 for trusts. From the 6th of April 2024, the annual exempt amount will be reduced to £3,000 or £1,500 for most trustees. Overall gains above the tax-free amount will be charged at a CGT rate of 10% if you're a basic rate taxpayer in the year in which the disposal takes place, and 20% on any amount above the basic income tax band if you are a higher rate or additional rate taxpayer in the year in which the disposal takes place. Your capital gain counts towards your total taxable income when you're working out your tax bracket. Therefore, a substantial gain could push your total earnings for the year above the basic rate threshold, which is currently £50,270 for the 2023-24 tax year. You need to bear this in mind when working out your tax liability. If you make gains from the disposal of your main residential property and do not meet the criteria for private residence relief, for example, if part of the property is used exclusively by your business, you will instead pay a CGT rate of 18% if you're a basic rate taxpayer, or 28% if you're a higher rate or additional rate taxpayer. You won't have to pay CGT on a business asset that you give away to charity. However, the disposal may be subject to tax if you sell the asset to the charity for more than you paid for it and less than the market value. Similarly, if you give or sell any business assets to your spouse or civil partner, you won't have to pay capital gains tax on the disposal unless you are separated and didn't live together at all in that particular tax year, or you gave them the goods to sell through their own business. You might be able to delay or pay less capital gains tax by claiming certain reliefs or costs related to the asset, but we'll discuss these in a bit more detail in a little while. When you sell or dispose of a business asset, the gain that is subject to capital gains tax is normally the difference between the price that you paid for the asset, or its value when you first owned it, and the price that you sold it for. However, you must use the market value of the asset to work out the gain if you give it away to someone other than a spouse or civil partner or charity, sell it for less than it's worth, inherited the asset and do not know the inheritance tax value, and if you've owned it since before April 1982. If you sell or dispose of an asset that was given to you and you claimed gift holdover relief, you must use the original purchase price of the asset to calculate your gain. If you bought it for less than it was worth, you must use the amount that you paid for it. You can ask HMRC's Shares and Assets Valuations team to check your valuation. To do so, you need to complete a post-transaction valuation check for capital gains form after the disposal takes place. To work out your total taxable gains and tax liability for the year, you need to combine the gains from each business asset and deduct any allowable losses, costs, and tax relief. The overall gains above the annual exempt amount will then be subject to capital gains tax. If your total gains are under the tax-free allowance for the year, you won't have to pay any CGT. However, you will still need to report your gains to HMRC if both of the following apply. The amount that you sold the assets for was more than 4 times the CGT allowance, and you're registered for self-assessment. The rules are different in that you need to report a loss on a chargeable asset, but more on this later. Moving on now to perhaps the most interesting part of the video for many, how to reduce your capital gains tax liability. Depending on the asset and the type of disposal, you may be able to reduce your capital gains tax liability by deducting certain costs and expenses, offsetting losses, and claiming tax reliefs. These are in addition to your annual tax-free allowance for CGT. If you incur certain costs or expenses because of buying, improving or selling a business asset, you can deduct these from the capital gain that you make. The costs that you can deduct include incidental fees such as acquisition, valuation, advertising or disposal costs, making improvements to an asset except normal maintenance and repairs, and stamp duty, land tax and value-added tax, unless you're reclaiming the VAT. Costs that you cannot deduct include interest on a loan that was used to buy the asset, and any costs that you can claim as business expenses. If you're unsure about deducting certain costs or expenses, you can contact HMRC for clarification. If you make a loss on any chargeable assets, you can reduce your overall taxable gains by claiming for allowable losses in your self-assessment tax return. You can deduct allowable losses from the total gains you make in the same tax year. However, you can also claim losses up to 4 years after the end of the tax year in which you disposed of the asset. This means that you can deduct unused losses from previous tax years and carry forward any remaining allowable losses to future tax years, enabling you to make full use of your annual exempt amount each year. You may also be able to reduce or delay your capital gains tax liabilities on business assets if you are eligible for tax relief. If you sell all or part of your business, you may be able to pay 10% capital gains tax on any gains you make on qualifying business assets rather than the normal rates. Business asset disposal relief is available to sole traders, self-employed partners in a business partnership, shareholders in a personal company, and trustees selling assets held in a trust. To qualify for business asset disposal relief as a sole trader or partner, you must own the business for a minimum of 2 years up to the date in which you sell the business. However, if you are selling shares in your company, both of the following must apply for up to 2 years up to the date in which you sell your shares. You are an employee, director or company secretary of the company or another firm in the same group, and the company's main business activities are in trading, as opposed to non-trading activities like investment, or it's the holding company of a trading group. Unless the shares are from an enterprise management incentive, the business must also be a personal company for at least 2 years before the disposal takes place. This means that you must hold at least 5% of the shares and voting rights in the company. Additionally, you must be entitled to at least 5% of the distributable company profits and net assets on winding up the company, or at least 5% of the disposal proceeds if the company is sold. If your shareholdings fall below 5% because the company issued more shares, you may still be eligible for this relief if you elect to be treated as if you had sold and repurchased the shares immediately before the new shares were issued. Doing so will create a gain on which you can claim business asset disposal relief. If you dispose of a business asset and use all or part of the gains to replace it or buy other business assets, you can delay paying the CGT that you owe until you dispose of the new assets. To be eligible for business asset rollover relief, the new assets must be purchased within 3 years of disposing of the old ones. If you operate as a sole trader or business partnership and you decide to set up a limited company, you may be able to claim incorporation relief if you transfer your business assets, excluding cash, to the company in exchange for shares in that company. This will allow you to delay paying CGT on those assets. If you give away business assets, including some types of shares, or dispose of them for less than they are worth, you will not pay any capital gains tax on them. This is known as gift holdover relief. Instead, the recipient will be subject to CGT if they later dispose of those assets. If you change your business structure from a limited company to a sole trader or partnership and acquire the company's business assets, it may be possible to claim disincorporation relief. However, CGT may apply if you later dispose of those assets. Private residence relief automatically applies if you sell or dispose of your primary residence as long as it has been your main home for the entire duration of ownership and no part of it is used solely for business purposes. However, if you use any part of your home exclusively for business purposes, such as a home office or studio space, you will have to pay CGT on that part of the property when you sell it. Now let's look at reporting and paying capital gains tax to HMRC. Capital gains tax must be reported and paid to HMRC. You won't receive a CGT bill. It is your responsibility to work out and report your gains or losses and tax liability. And you can do this in one of two ways. By using HMRC's real-time capital gains tax service, which is for UK residents only, or in your self-assessment tax return. If you are in a business partnership, you will need to work out and report your share of each gain or loss. The nominated partner must also complete Form SA 803 on behalf of the partnership itself. Whichever way you choose to report and pay capital gains tax, you must ensure that you have the date on which you took ownership and disposed of the business asset, details of the price you paid for the asset and how much you sold it for or its market value, any additional information that may be relevant, such as deductible costs, allowable losses and tax reliefs, and calculations for the capital gains or losses that you are reporting. Once you have reported your gains to HMRC, you will receive a letter or email containing your 14-character CGT payment reference number that starts with an X. You must use this number when paying your CGT using HMRC's online tax payment service, through online banking, or by cheque. However, if you reported your gains in your self-assessment tax return, you would normally pay the tax you owe as part of your self-assessment tax bill. The records you will need to keep to work out your gains and report your CGT liability include bills, invoices and receipts showing how much you paid for the asset, additional costs related to buying, improving or disposing of it, tax reliefs, how much you received for the asset, contracts relating to the purchase or sale of the asset, and copies of any valuations. You must keep these records for at least 5 years after the self-assessment deadline. So there you have it. Whether you run your business as a sole trader, partnership or limited company, there may come a time when you must report and pay capital gains tax on the disposal of business assets. The rules and regulations can be incredibly complex, particularly when selling a business, so it's worthwhile seeking professional advice from an experienced and reputable accountant. If you have any questions, please leave them in the comment section below and we'll get straight back to you. In the meantime, we've included several useful links in the description below. Finally, be sure to subscribe to our channel to get more tips and advice on limited companies, reporting requirements, tax obligations and more. We're always happy to help and we can't wait to hear from you. Until next time, see you later.